Research from New York University Stern School of Business spotlights the risks and downsides of reverse stock splits. In 1,600 reverse stock splits from 1962 to 2001, shares underperformed non-split peers by 15.6% in the first year after the split, 36% in the second year after the split, and 54% in the third year after the split. I'm Jonathan. I bring you the market news in context of believability so you can save time, you can trade your way, and you can make money. In March of 2021, the board of GE recommended to its shareholders, to its management, that the stock should be reverse split. In May of 2021, the shareholders voted and approved this reverse split. In June of 2021, the date for the reverse stock split was chosen. The date chosen was the end of July, beginning of August. The focus of this video is on the believability of GE's board, specifically on the stated reasoning for this stock split. They have stated that the number of shares outstanding is just simply too many and they need to reduce that number. It makes no sense. I'll look at some different factors, from the market reaction to past performance to outside criticism, and then tell you in the end if I think it's just smoke and mirrors and it's a trick to try to trick the market, or if there are valid reasons and it's a legitimate thing. The first thing I looked at was a share price development since the split was announced, and I wanted to see if investors are very happy and the price went up, or if investors are very sad and the price came down, or what really happened was the share price just went flatlined since the announcement of the split. The next category of reactions I want to look at is the outside or media perspective. One thing pointed out from Bill Gates in his book is that the performance of GE over the past decades has been abysmal. Specifically, he says, pride, delusion, and the fall of General Electric. Founding story includes the innovator Thomas Edison and the financier JP Morgan. We see here that GE does have a significantly higher number of shares outstanding, and this can be attributed to the fact that GE has split their stock many times. Taking a look at three specific areas where GE failed, we look at the failure to plan. GE did not plan for the future. They did not plan for their current products becoming obsolete or their current products falling out of favor. Another area where GE failed is their continual underestimation of competitors. They didn't take the competition seriously. They never tried to beat their competition. They assumed that they were always better and it would always be so. Because GE had a reputation and a tradition of just bringing on new companies, purchasing, buying, accumulating all the assets that they could, they became such a large and slow-moving behemoth that they were never able to be nimble. They were never able to adjust when they needed to. They just fell over in the end. Kevin Welch talks about what a reverse stock split is. They explain reverse stock splits are when the number of shares outstanding is decreased. This doesn't take place nearly as often as stock splits take place. The most common reason for reverse stock splits is that New York Stock Exchange and other exchanges, they set limits on the minimum share price for a stock to be included on their exchange. So in order to meet these limits, sometimes companies have to reverse stock split to make their price higher. There are some positive examples of reverse stock splits, such as Xerox. Xerox has been able to maintain their momentum over the past few years. Another famous example of reverse stock splits is Citigroup. Citigroup reverse stock split back in 2011-2012 timeframe after they'd had the disaster during the financial crisis of 2008. There are a few other positive examples of reverse stock splits, but the main takeaway here is that most stock splits, as reported by the New York University report with Emory, show most stock splits fail miserably. Most stock splits are intended to increase the stock price just so that companies can stay listed. Some pros: it keeps the stock listed on the exchange, can help relieve selling pressure, can be a sign companies considering the needs of the shareholders. Some cons: can be an indicator of poor performance, could signal sinking stock. These pros and cons have no impact on the company. The number of shares outstanding, the price per share has no impact on the company insofar as that it doesn't change the market cap. It doesn't change who owns anything. It doesn't change voting rights. The only thing that changes is the price. A reverse stock split for GE would make them one of the few blue chip companies to ever reverse stock split. Normally these big companies, these blue chip companies with such a large market cap, are splitting their stock, like Nvidia, Apple, Tesla in recent years. One positive GE could get out of this in the long run is that they could reduce their dividend. The Motley Fool pointed out a few things about GE. they pointed out the earnings and cash flow are weak, erosion of credibility within the investing community, and their future prospects are not all that great. If we look at NASDAQ's response, we can see that they are just towing the company line. They are pointing out what the GE board members want everybody to hear, which is that they're trying to reduce the number of shares outstanding, not that they're trying to manipulate the share price. The reverse split will be effective July 30th, which means the new shares, the reduced number of shares, will begin trading on August 7th. If we look at some other examples of reverse stock splits, but not in companies, but rather other areas where they're more accepted and they're more business as usual, we can look at two ETNs, VXX and SQQQ. VXX is the ETN tracking the VIX, SQQQ is the short NASDAQ ETN. In both of these scenarios, these ETNs regularly undergo reverse stock splits in order to bring the price up because the price is continuously falling due to the nature of the product. The too many shares argument is a bit interesting because it's just the other side of too low of a share price. Over the last 10 years, with stock splits included in this calculation, the CAGR has been negative for GE. Again, GE made bad choices. They failed to plan, they failed to take into account the competition, and they failed to be nimble. They failed to make the decisions at a tactical level and just fizzled out. What do I think? Do I think that this is all smoke and mirrors, or do I think the GE board is telling the truth and that they are really trying to help out their investors, or at least not causing harm to their investors? I do think it's all smoke and mirrors. I think GE board is saying that they want to reduce the number of shares outstanding, but what they're actually meaning is increase the share price. They're not in danger of getting delisted, but they do want to make themselves look more attractive so that the mutual funds are more interested in GE. And they see them, oh, they've got a share price of about $100 per share. That's much better than, 12, 13, but it's not. This is a fancy way of saying our share price is too low and we need to make it look bigger. 3 digits are better than 2. Do me a favor and answer this question down in the comment section below. Stock splits are bullish. How can reverse stock splits not be bearish? That's all I have for you today. Jonathan out.